Thanks first and foremost for everyone joining. So let's go ahead and go into it. So this is going to be an annuity training call talking about everything related to annuities, what they are at its core, and how they operate, how it can help our clients when the product is suitable for them. Okay. So annuities itself, right, is something that's scary and agents are afraid to talk about. They don't know how to sell something they're not educated on. It's people's retirement money that they might be moving over, right? So there's a little bit of fear and uncertainty with a lot of agents, and I totally understand that. And there's different types of annuities for different types of people. Okay, so we'll go into that as well. But basically, why it's so attractive and appealing to the people that we sit down with is because it gives them guarantees, right? There's no guarantees in the stock market. I could buy Amazon stock today and it could go to zero tomorrow. Of course, the probability of that with that particular company is very low, but you get the gist of it, right? Things can happen and things can change. And also you have to keep in mind that annuities themselves, they're invested, as we're going to go into here shortly, they're actually invested and correlated with the different markets, indexes that you'll see, and I'll be able to point them out so you can see exactly what it is and how it operates. Okay. So they're tied a lot of times to, let's say, the S&P 500, right? The Standard & Poor's 500. So you got your 500 companies that compose the Standard & Poor's, the S&P 500, and that is then what dictates your return, right? Which is the percentage, the yield, the interest that you accumulate on the product. Okay. So a lot of times when it comes to our final expense clients, you're not going to be running into $1 million, $10 million annuities, but what you will be running into a lot is you're going to be running into 30, 40, $100,000 annuity, which is really common. Someone that worked a job, and most of the time it's generally speaking going to be a 401k, which is just a form of retirement account. And whenever they retire from the employer, they usually roll it over, right, to another brokerage firm that holds the money. And these people genuinely have no idea what's going on with their funds, right? They don't know how the money's managed. They don't know how it's invested. But what they do know is the pain associated with major market collapses, right? And that's a big thing, right? So if you look at what their 401k is composed of, right, it's going to be composed of a lot of mutual funds most of the time. And mutual funds, of course, they have fees associated with them. And the fees are pretty hefty, right? So those fees are pretty staggering to see, which takes away from your return. So not only are you getting charged fees, okay, but you're also have risk exposure to a Lehman Brothers going out of business, and your portfolio is correlated to that specific company, right? So that's definitely an issue. When we get to dealing with our clients in this market, one thing that we know with absolute certainty is they don't want to take risk. This is their nest egg. This is what they've worked their entire life for. They want the G word. They want guarantees. That's why from us, they're buying a whole life policy, right? A guaranteed fixed rate. We like to provide guarantees. That's our solution. Okay. And we don't ask agents to be the investors themselves and take these retirement accounts or just cash that they have sitting around, and we'll kind of, distinguish what to do with each set of funds. But we don't ask you to be an investment expert, right, and understand how all this stuff operates at the core and trade the stocks for them or anything along those lines. That's not what we're asking you to do. What we're asking you to do is really and genuinely help out your clients and put your clients in a good situation, the best possible situation that you can put them in. Okay. So whenever I look at an annuity, I look at it from the perspective of a few different things. Okay. So let's go over some different examples of why I think it might be suitable for a client. Let's say, for example, you sit down with a client, and right now you're looking with a client at a fixed, what we would call a MYGA, MYGA. So there's different terms, just there's a million acronyms in insurance, right? So one of them that we look at is called a MYGA, which pays a lot just in terms of like a commission perspective, because they give a guaranteed fixed rate, the highest that they can give. The commission's lower as well. Okay, so there's a trade-off. but that doesn't matter because it's what's most suitable for the client, right? So what's going to benefit the client the most? Well, what benefits the client the most is, for this particular situation, is a client that says, hey, I don't want to take any risk. I want a guarantee. I want my money to be to be put inside of a CD, and a CD is a certificate of deposit. So if I'm just going to type it into Google right now, right, which I haven't looked at yet, but I'll tell you right now, because the CD rates, they change. But let's just go ahead and type in CD rates, and I can go with like a 13-month or something like that. Okay, so let's go ahead and see 13 to 36 month CD rates. So let's go ahead and just go over this real quick. Let's see what the rates are. So let's go to Wells Fargo. Here's one that pops up. 4.75% yield. Oh, this is what me and Josh were working on the other day, actually. This is a 4.75% yield, and it's a 7-month term. Okay, so it lasts for 7 months, and you get 4.7% on your money. Okay, so that's not bad at all. You're going to get 4.75%. You put in $100,000, you get $4,750. Cool. Okay, that's pretty easy, right? And a CD is very low risk, right? There's very low risk. If the bank goes under, then yeah, you'd lose the money. But the risk is very low for those individuals. So it's called risk tolerance, right? So how much risk does someone want to take? In an annuity, you can't really take a lot of risk just in general, right? You can't be too overwhelmingly aggressive. You can't just buy one stock. You can't choose stocks inside of it, as an example. But so we would use what's called a MYGA, MYGA, which stands for a multi-year guaranteed annuity. And a multi-year guaranteed annuity is something that provides a fixed flat rate, and that's it. Okay, so it doesn't matter with the client. You know, there's no, hey, if the S&P goes up 20%, this goes up, you know, and you earn 10% or whatever it is. It's simple. So right now, the one that I see that's the highest in terms of MYGAs is 5.9%. And they're going down, right? So they go down all the time, right? They decrease or increase, and that is dependent upon what the Federal Reserve sets interest rates at. So if the Federal Reserve says, hey, interest rates are going up, they're going up, they're going up, they're going up, well, that's what's going to dictate what the banks, right, and the insurance companies are then going to provide these rates at, right? So it's pretty simple. Now, the Federal Reserve says, hey, next year, in 2024, rather, right now, we're going to do 3 cuts this year of interest rates. So that could mean that they go down, 25 basis points. They could go down, 1 full percentage point. Who knows? But we do know that since that's going to go down, that means that CD yields are going to go down, and that means that the MYGAs are going to go down, multi-year guaranteed annuities. So sometimes people just want safety. They want a guaranteed return, and they want a guarantee that they won't lose their money, which they get inside of a MYGA. Okay. Inside of a CD, they get a guaranteed return, but could they lose their money? Yeah. I mean, it's definitely possible. They could lose that $100,000 that they put in. Now, that's just a simple, easy product to sell, right? I think any of you can, on here, you never sold an annuity, you understand what a MYGA is now, right? A multi-year guaranteed annuity. It's going to give you a guaranteed rate for multiple years. That's all that it is, right? So it's a very simple product. Then we get into, well, what if a client doesn't just want a fixed rate and they say, well, my retirement account, it's been getting me 7% every single year. Okay, great. Well, let's look at something that can get you a little bit more than that, right? Upside potential. And then there's different types of products and different companies that we work with that will provide that different product to the clients, right? So with the annuities, there's a lot of different companies that we work with, of course. But one thing that I think it's really important for people to understand is when you're inside of an annuity and using an annuity as an investment product, okay, the beautiful thing about it is that you have the ability to have no loss at all. You cannot lose any money. That's the biggest thing. So I'm sitting down with Miss Mary. I'm talking to Miss Mary. Hey, you right now have a 401k, okay, and you're 65 years old. You have felt the pain of 2008, the 07, 08 crash that lingered on for years after that, right? You have felt that pain from that point in time that caused interest rates to be at lows until 2022, 2023, record lows for a decade or more than a decade, right? You felt perhaps the internet bubble crash, 99, 2000, or March of 2020 when COVID hit, right? You look at your statement, quarterly, semi-annually, annual statement, and you look at it and you're shocked that you've lost money, that how much money you have in your account has actually gone down, okay? That is absolutely unacceptable. When you're that old, you can no longer take risk. So a lot of clients, it's commonplace now to see someone that will roll their money over to an annuity to have a couple different guarantees. One guarantee that they're going to have is they're going to have that they can't lose the money that they put in. So you put $100,000 in, you cannot lose that $100,000. Okay. Not only can you not lose the $100,000, but you can't lose the $100,000 plus the interest that has accumulated at the end of that anniversary year. Okay. So let's say, for example, with these policies here, which we're going to look at, I'll show you with these policies here that it's what's called, they have these terms. There's a bunch of different terms and the terms can get confusing, and maybe, terms can be confusing to the point where it creates a job for people, right? Make it so confusing that you need someone to explain it to you, right? And that becomes a job and a profession, kind of like Medicare and how confusing Medicare is for a lot of clients. Okay. So you have this time frame that determines what your interest rate's going to be. Okay. So they call it a point to point. Okay. And all that it means is if you drew a line and you started at January 1st, 2024, okay, as the beginning of the point, the beginning of the investment period, and then the end of the point would be 12/31/2024, December 31st, the end of the year. However much that S&P 500, as this example, went up at that point in time, that's how much interest you accumulated. So it doesn't matter if it's up 15% in the first quarter, and then at the end of the year, it's down 20%. Okay. It's all about whatever it is at the end of that point, that period of time. Okay. So it's a 1 year point to point, or they do what's called 2 year point to points. Okay. So now with that said, for us as agents, well, we want to look at it. We get a lot of benefits for our clients here with using an annuity and using different strategies to help them. And I'm going to play around with the strategies and just show you inside of the illustration center so y'all can see exactly, what we're looking at here based on different strategies that are preset, okay, by insurance companies, and how we can kind of play around with the numbers and look at them. And we'll look at different products. We'll look at all that stuff. So we'll do some really cool things, different products by different companies. So we have different carriers that have different solutions. They pay different commissions. They have different products. Some products from annuity companies are designed for people that have some type of, the way that they read it is if you have if you need assistance with 2 out of the 6 assistance with daily livings, ADLs, right? Okay. Bathing, toileting, getting out of bed, dressing, stuff along those lines. Okay. So if you need assistance with 2 out of 6 of those things, with annuities, the money that you're drawing out of it, your payment will be doubled. Okay. So we'll go into what that means and how some of these products, specifically by the one that I'm going to look at over here with Athene, kind of how that works. Okay. So let's go ahead and let's do a little share screen and go into some of the annuities that different companies have. Obviously, Athene's one of the biggest companies in the entire country. I mean, they're probably top 3 when it comes to annuities in terms of size in the entire country. There's a ton of different companies out there. Obviously, as you know, Royal Neighbors, they have a MYGA, multi-year guaranteed annuity. They're really good with that. They're very strong rate. as well. And every company is different with different rates. So that's why we always shop them to find out what's best. You know, if we get a 5.25, 5.5, 6%, right, that we're always shopping to see. And these things are changing. They're changing all the time. What might be best today, you know, might not be the best tomorrow. And tomorrow could bring a better rate than it did the day before. It's like we look at it based on what the Federal Reserve is dictating the interest rates at. Okay, so let's talk about the kind of annuity and the design of it. What's the whole intention of it? So the whole intention of annuity is for income purposes, to actually draw income out of it. And you have different types of products that you have. So you'll have products that are designed, which is called the Ascent Pro by Athene, the Ascent Pro. And what that product is that one in particular is designed for someone that strictly wants to take income from the product. They're not looking for accumulation. I'm 75 years old. I just want a guaranteed income check every single year. Okay. I want a guaranteed amount for the rest of my life. I want a guaranteed amount for 10, 15 years, right? I want a guaranteed amount of my money coming in. It'll earn a little bit, but it won't have a lot of accumulation. It's not designed for growth. Okay. So that's the Ascent Pro by Athene. Okay. That's what that product is. Now you don't have to take the income immediately. You can do what's called deferred income, which means that you can have the income start in 2 years, 3 years, 4 years, whatever, right? And the longer you defer the income, the more money that you'll get on a monthly basis. Okay. So, and let's draw up an illustration on that and we can look at it. So what does that mean? Okay. So, well, that means that whenever us as agents, okay, whenever we have a client that wants money, but they don't need the money now, we of course would want to go ahead and allow them to defer that for 2 years, 3 years, 4 years, so they can have a guaranteed increased rate. So let's kind of compare that to someone that's going to draw Social Security. If you take the Social Security at year 62, well, you're going to have the lowest amount of money in terms of your check. If you take it at 65, it's going to be higher. If you take it at 67, it's going to be higher. If you take it at 70, it's going to be higher, right? So the longer you defer it, the better in terms of Social Security. Now, the key with Social Security, obviously, is you got to live. So that's obviously an important factor with that. So it's really up to you. So we have something that you can have income drawn up immediately, and we could draw an illustration for that. Okay, so we can look at it. And then we have some products, one in particular by Athene, which is called the Agility product, right? It's agile. That's how they define it. And basically what it is it's an accumulation product initially, and then turned into an income-based product. But the downside is you have these things called cap rates on a product. Like, well, what does that mean? Well, what it means is that they cap how much money that you can earn, right? Just like a life insurance policy, the most that you could take out is $30,000. That's the cap of the amount that you can have. That's the most that you could take out is $30,000 in a life policy. It's the largest face amount. Now, with some of these products, with Athene, for example, they have one of their products, the Elite product, which we'll go into in just a second, has a cap rate on the Standard & Poor's 500, the S&P 500 of 11.25%, meaning that's the cap. That's the most amount. The S&P 500 goes up 30% in a year. The most that you can earn is 11.25%. That's the most that you can earn. But if the S&P 500 goes to 0 and it's down 100%, the least that you can earn, your floor, is 0, right? So it could be the worst catastrophic event and you're inside of an annuity, you're safe, okay? That's why they're powerful. So you might have a cap in terms of upside potential, but you have an amazing, amazing floor of 0%. That's the least that you can earn. Plus, you got to think of the benefit as well. Well, the benefit in addition to that is not only are you going to be able to earn money, but you can't lose any money in addition to what you've put in, plus the interest that is accumulated. So let's just say, for example, year one, I put $100,000 on the product. I now have earned 10%. The S&P did great. S&P 500 was up 16%. And I had a product that was capped at 10%. Okay. So, which is good for the annuity company. Hey, they made 6%. They made their margin. They're happy. Right. And we're happy because we made 10% and we didn't lose any money. Now, year 2 happens and we got $110,000 inside of the company, inside of our annuity. Okay. And again, we get a nice little 10% return. We hit the cap again a second year. No one's mad about that. We got $110,000, 10% of that's 11 grand. Now we got 121,000. Then year 3 is 2008 and the stock market crashes and your retirement account is down 40% and you're supposed to retire at the end of the year and you can't, and you don't want to be a Walmart greeter, right? You're protected. You earn 0% and you still have $121,000. The amount of money that you put in plus the interest that is accumulated, you get to keep. That's safety and security. That's peace of mind. That's a solution to a problem. That's what we sell. Okay. As long as it's suitable for the client. And a lot of times what we're finding is that it is. They just don't want to take the risk. Now they don't have to put all of their money in it. They don't, if they have $800,000, they don't put all $800,000 inside of it. They can diversify their portfolio. Let's see how these stack up against each other, right? Let's see how they work. There was what was it, 2022? The stock market was down 18% for the year, somewhere along those lines. Absolutely horrendous year. People in annuities didn't earn anything. Yeah, sorry, you didn't have any growth, but you didn't lose 18%. Now this year, past year, 2023, did great. It was a lot better. Obviously, when something's down 18%, you know, hopefully there's upside potential. So that's a phenomenal thing. So to go back to that, there's what's called they call it a cap rate. It's just the ceiling that you can earn, right? That's the ceiling. That's the top. That's the highest amount of interest that you can accumulate on your product. Right? So most of it is called a cap rate. Okay. So let's go over one other term that I want to go over with y'all as well, which is called it's another term that you see, and it's called a participation rate. So we're going to share entire screen and y'all should see this. Let me just wait for it to load over here. And we're looking at it. Okay. Now, with that said, what we have over here, okay, is they have these terms inside of annuities. Wrong one. Here we go. Inside of annuities, they have these terms. And one of the terms is called our par rate or participation rate. And what does that mean? Give me all these terms. It's confusing. I don't understand it. You know, riders, cap rate, MYGA, par rate. Like, what does that mean? Okay. Well, a par rate is the participation rate. So that's actually going to be a percentage of what your interest rate is, that if you invest your money inside of it, right, that's what you can earn. Okay, well, unpack that for me. Okay, great. So let's just start off here with our simple 1 year point to point on the S&P 500. Okay, whatever the S&P 500 does, our cap rate, right, the ceiling, the most amount of money that we can earn in a year with this particular product is 9.75% with a 1.25% charge. Okay, meaning realistically it's 9.75% minus 1.25%. The most that you can earn is realistically 8.5%. Because what that means is that they're charging you 1.25%. That's how much money they're charging you. That's their fee, right? So we're going to charge you 1.25% on a monthly basis, or no, that's an annual basis right here, in order to have the ability to earn more money. But if you do it with no charge, there's also a no charge strategy option here. So there's a no strategy charge. You could do that. The most that you can earn is 7%. So if you want to pay some money, you can earn 1.5% more. It doesn't seem like a lot, but when you do compounding interest, it's a substantial amount of money. It's by no means a small. 1.5% is a absolutely tremendous difference in interest compounded over an extended period of time. Okay, that's a very serious amount. So don't just look at it and think, well, 8.5%. So that would be your ceiling right there on that. So that's a 1 year point to point. What did the S&P 500 do in that 1 year period of time? Okay, the S&P 500 went up a total of 12%. Great. My account is credited 9.75% minus the fee of 1.25 that they charge me. Okay. That's your cap rate. That's your ceiling. Now we got these other things over here with the participation rates. So participation rate basically means this is how much you'll get of whatever the yield is. So they call it interest credited to your account. So if we just go ahead and say that this index, okay, right here, it's called the AI Powered Global Opportunities Index, IGO, okay, that one, if you put your money inside of it, and IGO at the end of the year, was up 8.5%. It grew by 8.5% at the end of the year. You would just simply just multiply 200% by 8.5%, and that's how you're going to get your increase, okay, of what it is. So in one of the examples that I had here, I had written down, let me see where it is. Okay, so there was another one that I was looking at. Let me see if it's in here. Oh, here's a better one for y'all to look at as well. This is the performance elite. Okay, that's the 10. Let's look at the 7 year. So just bear with me on this while I go ahead and do that. Okay, so strategy charge, basically 2.5, so it's 200 there. So let's say, for example, it was up 8.5% times 5. Almost doubling what the interest rate is on it, and that's why they're so attractive. So it's basically 8.5 times 2.5, so that 21.25%. So your par rate, your participation rate, means that it's literally participating at 250% of whatever their interest that strategy earned that year, right? You're getting 250% of whatever it is. So if it came back and was like, hey, you earned 8%, well, and you had a 125% par rate, but they earned 8.5%, what's credited to your account is 10.625%. Okay. I know it's a little confusing, but it's a strategy that they use in order to get you more money than what just the S&P 500 has, right? Because what Warren Buffett said, if he died tomorrow, and he said this, decades ago, what would he have his wife do with all of the money? And he said, well, I would go with 10% of the money would go into treasury bills, and then 90% of the money would go into a index that tracks the S&P 500 as close as possible, right? So like, for example, VOO, which is a ticker symbol, a stock ticker symbol for a ETF, an exchange traded fund that tracks the S&P 500. Okay. So that's a simple strategy. You could literally take this money from this client and put it into the S&P 500, and nothing will beat it. No hedge fund is going to beat the S&P 500 over, extended period of time. So let's go ahead and just look at that so I can show you guys on a chart through Yahoo Finance. So let's go ahead and just look at the S&P 500 so y'all can see what I'm talking about here. If we go to the max time frame, so it's bringing us back to only 2010 here on the max. Let's see if it can do an interval of 1 year. If it can do that, yeah, it's pretty cool. Okay, so it'll show you what the interest is, but it's only going back. There we go. Let's see if it goes back further. No, it's not pulling further data, but that's okay. So what you have here is all these greens are years that you're winning, right? So if think about it this way, you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and it's giving us 11 years, right? So 10, 11, 12. So 12. So 10 wins and 2 losses. But those 2 losses can be absolutely catastrophic losses, right? 2021 could be an absolutely catastrophic loss. You could have lost a substantial amount of money when it went from here to here, right, on the chart. And then in the good years, when you're winning on that, you go back to this chart that I had over here. you can earn 12.75% on your money. And that's easy money, right? The S&P 500 over an extended period of time is not going anywhere. So let me actually track the actual S&P 500 itself instead of the VOO. So there we go. Okay, so it does pull it. I'm showing it in the form with, okay. So this is actually going back a lot further. Okay, so when it opened, 1928, S&P 500 when it opened. So when it opened all the way in the beginning of time, it was $23.85. 17 bucks is actually 1927. It was $17 for the S&P 500, which tracks, the largest 500 stocks that they put inside of that index. And then, as you can tell over here, it's done nothing but go up. Nothing is going to ever beat the S&P 500. Just doesn't happen, right? Hedge funds don't beat it over a decade period of time. So you could literally just take your client's money and put it into the Warren Buffett philosophy and strategy that take all my money and put it inside the S&P 500, but put it into an annuity and never lose any money at all for the client. They're guaranteed to win. And 10 out of the past 12 years, they win money. Like they're literally winning money. 12.75% minus the 1.25% charge here, you're earning 11.5% on your money. It's like a no-brainer. You can't lose any money. The money that goes into the annuity itself, I get to keep all of that money. I put 100 grand in, I get to keep all of that. And then if it goes up 12.75%, I get to keep that. And then if it goes down, the stock market goes down 40%, I don't lose any money. Yeah. Well, what's the negative? Okay. Well, the negative is that you have these things called surrender charges. Okay. And what a surrender charge is, a surrender charge basically means that if you try to take money out of it, okay, you try and take money out of the annuity, you're going to pay a fee to take the money out. And that fee is a percentage. Okay. So if you try to take the money out year one, you might lose 7% of your money. Or here it is. Here it is right here. Year one, if you try and take that money out, you're going to lose 9%. Year two, 8.8%. Year three, 7.9%. Right? So annuities are not liquid products. Now, can you take money out of them? Yes, you could take money out of them. Right? But annuities are not liquid products. So basically what that means is that it's not a product designed for someone that wants access to their cash to take it out. Okay. But either way, it's in a 401k. They're not going to take out a substantial amount of money anyways. And even if they did, right, they're not going to take out all of the money if they put in $100,000. Okay. So they might just need to take out 10% or 5%, which is acceptable, and every product varies a little bit. Okay. So that's the downside, is the liquidity aspect. The annuity company has to keep your money for a period of time to say, hey, I think I can do better with your money than what you might be able to earn. Meaning that if we say inside of our product here that if you're just tied to the S&P 500, it's 12.75% is what you're going to earn. We think that if you give us $100,000, we think every year we can earn 16% on that money. And we only have to give you 12.75% of it. That's not bad at all. Like, that's a tremendous win on hundreds of millions of dollars, a tremendous win. So they absolutely love that. And they're keeping the margin. They're keeping anything above that 12.75%. And they get to charge you a 1.25% fee in order for you to get that 12.7%. So it's realistically 11.5%. So if I was to just draw up a strategy, I'd say this is the easiest thing to do, right? I mean, 10 out of the past 12 years, you're winning. It's pretty easy, right? So now let's go and do some illustrations so you guys can actually see how the product itself works. So this is just a themes product that I have here. I have selected the Performance Elite as the product, which is the one that we're talking about. And this, we're on the 7-year product. We can change it to the 10-year, and let's look at it. We'll play around with it so you guys can kind of see, how the product illustrates itself. Okay. One other thing that I do want to touch on as well before we actually go into that is what's called bonuses. So the annuity products, they have this thing called a bonus on it. Okay. So you'll get a bonus on the product of 10%, 11%. And what that does is it offsets their losses from their other 401k, or it offsets surrender charges from another annuity. Okay. So that's pretty cool as well. Okay. So keep that in mind, that they can get on the 10-year product. The longer you give the annuity company the money, the higher they're going to give you a bonus, basically. Right. So if you do like a 7-year product, the 7-year product, if it even has a bonus on it, good luck with it. So a lot of them, you might not even have it. Whereas with the 10-year product with Athene, you get 11% bonus on your money. So you put in $100,000, you're getting $11,000 credited to it. If you look at let me look at another product here. Some of the products have just ridiculous bonus amounts to them. Now, you don't get access to the whole bonus. You have to be vested over a period of time, right? They're not just going to give you the money and let you just take it out, but it's still a bonus. It's still money that's additional money with the incentive of you moving the money over so they can manage it, and hopefully they win. And then there's also, which we already looked at, which was those charges right here where it says strategy with charge. You call that a rider, basically, right? A rider to increase how much money you can earn. This specific product, this one that we're looking at over here, is a 7-year, because that's what we'll look at in the illustration, but we'll illustrate all the different products. Its 10-year free withdrawal amount is calculated by applying the percentage shown to be accumulated value. So you get 10% free withdrawal on the annuity. So there's liquidity issues if you want to draw the money out. Okay. That's where the liquidity issues are. If you want to take all of it out, you lose 9%, but they're going to give you 10% free withdrawal. Okay. I mean, how much liquidity do you need inside of this product? Are you going to need more than that? Okay. I don't know. Maybe. Probably not. Most people don't. And then if you do, then this isn't the right product for you. It's not suitable for you. I can't put you inside of it. Keep it wherever it is. But if it's in a 401k or an IRA, you're not going to take all the money out of it anyways without penalties, depending on your age, right? So I'm not even concerned about that. So let's just say, for example, let's draw up an illustration here. Initial premium, $500,000. I'm looking at the 7-year product, and then we also have the 10-year product. We'll start with the 7-year product. Okay, so I just created a case in here in Athene's website, and they're not the only company. So another company I was looking at is Atlantic Coast Life, and the reason why I like them is because so far, I mean, I still keep shopping, but so far they're the highest amount that they'll let you participate in the S&P 500. They'll give you 14.5% with a 1.25% fee, meaning that you can earn 13.25%. This Athene product was 11.5%. They're giving you 13.25%. It's a tremendous difference. So that's huge. So every product, varies. They're all a little bit different. Every single company is different. And then you can have a product that's strictly designed for someone that wants income and they want to take income out every single year. And that's all. They don't care about the growth of it. They're not care about what the S&P 500 does or it doesn't do, or, all these other, IGO, Apex, BNP, that they don't care about what all that stuff does. They just want income, a guaranteed check coming in for the rest of their life. Well, Nationwide has a really good product for that. It's the Nationwide Peak product for 10-year income, right? So that, hey, if they have 2 of the 6 ADLs, or they're putting a nursing home, they're confined to a qualified care facility for 60 days, they can draw 100% of the money out with no penalties. There's your liquidity, one. And you can also buy a rider to have liquidity. You could pay, 0.95%, almost 1%, to have liquidity. So if you wanted liquidity, you can buy that as well in terms of a rider. But another thing that's really tremendous for us is if someone does want a guarantee and they have home health care, or they're confined to a facility or something along those lines, or they need 2 out of 6 ADLs, assistance with daily living, then they can get double the distribution on a monthly basis. So let's walk through that stuff in the illustration. All right. So what I did here, I got the $500,000 $500,000 annuity. I have a preset strategy. So what I did was I just said to the company, hey, you just tell me what you think is going to be the best for an illustration. I'm going to put it as a growth portfolio or accumulation. Okay. I want it to grow. And it's a 7-year product. So what does this look like based on their strategy? They say, hey, this is how we're going to divvy it up. And then what the companies do is they reallocate the strategy, not every single one, but they reallocate the strategy based on what was the poor performer, what's the good performer, get rid of the bad, and they increase the good. Okay. So then which is strategy reallocation, which you can usually do every anniversary year. So they'll go ahead and they'll do all that stuff for you. They manage the funds for you. You don't have to pay any additional fee too. They'll manage it all, right? So on this right-hand side over here, what you can see is, let me zoom in over here, is it tells you, hey, this is what your initial premium is. And well, let me scroll down. Okay, zoom out a little bit. And then at the bottom, or right here, accumulated value of the product itself, okay? So with their strategy, what they're saying is that after year one, we're going to have an accumulated value in the product of $535,000. And then what you do is right here, you could just put the value in and see how it kind of grows over time. Okay. So here's the easy way to do it with the quick view. Okay. So I just click that and I can download the illustration, everything, and that's absolutely fine. And then it'll tell me all the stuff that I want to know. So, okay. So what I did here is a view option. It has standard. Here's your guaranteed, right? Okay, that's fine. And then what we have is the accumulated value on the most recent 10 years. So what did this strategy do in 10 years based on the performance that they have allocated in the past 10 years, the past decade? How is this strategy performed? What's the accumulated value? Okay, after year one, right? It tells you right here. Look at that. So by year 7, you're getting $2 million in this strategy. Okay, $2 million. Year 7 with that strategy. Okay, $2 million. So that's pretty solid accumulation, right? And this is an illustration, of course, so we want it to look good. Now, the next thing I want to look at is, well, what if I want to manually allocate the strategy and I want to go and put it with the S&P 500 with the charge and go 100% on that. And let's see kind of how that looks. And then play around with those numbers. Okay, so we can then kind of see over here what they think that it would perform at. So obviously the performance doesn't look as good, right? Year 7, I'm only at $800,000. Not really too attractive relative to what they're saying that they can get us to $2 million when they go ahead and determine what the strategy is with a growth strategy. So, and that's most recent 10-year performance. I don't know anybody that would be upset if they put $500,000 inside of a product, and based on the historic 10 years of the Standard & Poor's 500, with the cap rate that we have on this product, the ceiling, the most amount of money that you can earn on this, which was 12.75%, you give someone, here's $500,000, and then in 7 years, you're going to have 300 grand. Based on what this is actual performance of the S&P 500. No one's mad at that. Obviously, when we went with the other strategy, that was a growth strategy, right? Whenever we adjusted it and we went to the quick view of it, and it says $2 million, it's a lot more appealing, right? That's 4x your money in 7 years. That doesn't really seem right, but can it happen? Yeah, I mean, absolutely. That's the performance of 10 years of their strategy that they built for you. Okay. That's a tremendous amount of money. So it's highly appealing. So I'd say, worst case scenario, you put everything in the S&P 500, and based on what the S&P 500 has done in the past decade, you'll have 800 grand. think everyone's happy with that. And full liquidity, after year 7, it's fully liquid. There's no penalties on it at all. And you can still take money out. And in this case, you could take out 10% free withdrawal. Okay. So you don't even have to worry about not being able to have access to the cash. If you need some cash, you could take it out. Just don't take out everything. So that's a tremendous product there. I mean, that's just amazing. Now, let's say we decide to go with the 10-year product on the same as I think. I didn't change anything at all. I just changed the product, the Athene product, from a 7-year to a 10-year. Okay. And that same strategy over a 7-year period of time is only $1.5 million. Same strategy. I did nothing different, but I changed the product. Okay. That's all that I did. Right. So when you change the product, there's obviously going to be different things inside of it in terms of the fees and how the product operates. Your surrender period is longer as well. Right. So then once again, I'll go ahead and I'll do a manual allocation here, and I'm just going to put 100% of it into the S&P 500 with a charge on it. So I can earn my 11.5%. And it'll calculate it here. It'll go to quick view, guaranteed, 7-year, 807 grand. Okay. So at that point, I'm actually winning a little bit, I believe. I'm up $7,000 if I put it all in the S&P 500, which is safe and secure. I mean, you can't, generally speaking, you can't lose money in annuity. I'm going to give you the guarantee on that you're not going to lose any money on it. But you can't lose with that strategy with the S&P 500. Like, that's always no hedge fund. Warren Buffett bet all the hedge fund managers in the country, hey, over a decade period of time, can anybody, I bet you $1 million, he said, can anybody beat the S&P 500 over a decade period of time? No manager was able to do it, right? Not a single one. So you can keep it simple, right? Here you go. This is what it's going to be. Past decade, real performance, real numbers, not pie in the sky. Or you can go with a really growth accumulation aggressive strategy that they have, right? And you may not get that full $1.5 million, but even if you got 80% of that, it's still a really healthy number, right? So that's not bad at all. And then you can look at the different types of products as well. So you can change the product and you can look at all their different ones. So the annuity, their MYGA, is a multi-year guaranteed annuity. And like I said, these are changing all the time. I mean, sometimes you're going to win on them. Sometimes you're going to not. But the withdrawals, we don't want any withdrawals at all. Their current rate, that's the 3-year. They have a 3, 5, and a 7, I believe. 3, 5, 7. So let's see what their rates are right now. Okay. So yeah, initial premium year 1, 500,000. Then you would earn 23 grand, 47,000 year 2, year 3. You're at 5. So yeah. So I mean, if you put it inside of a MYGA, you sit down with someone and they're looking at, and this one's Athene has now become on the lower end. Actually, they were one of the highest, and now they're one of the lowest. Or not one of the lowest, but they're lower than the other companies. So a few months ago, they were like great. We loved them, and then they lowered the rates a lot, and now they're lower than other company. But they're MYGA. So you're sitting down with a client. They're like, I don't want to take any risk. I don't want anything, and also put my money inside of a CD. Oh yeah, no problem. Okay, so this is a 3-year CD essentially, right? It's not a CD, but it's essentially operating the same exact way. It's multi-year. It's a guaranteed rate for multiple years. Or with that, with a CD, it could be 13 months. It could be 36 months. So it's the same philosophy. You put in 500,000 at the end of it, you have 73 grand. Okay. That is greater than what you put in, and it's guaranteed, and you can't lose any money. Guaranteed. It's that simple, right? It's not a complex thing to do. Now, the commission percentage, of course, everyone, that's what comes to mind with agents. I mean, you're going to be at like 1%, 1.5% instead of like 5%, right? So yeah, it's a pretty big difference, but you have a client for life there. And then, after that 3-year strategy is up, you go back to them when they're 68, they turn to 69. Now it's up. And as you can see here, after that 3-year period of time is done, they got to go into something else because you're not earning any money. They have the ceiling then becomes, I think, like 0.75 or 1%, whatever it is. And that's like the max that you can earn. So you're going to change it at that period of time. Well, then you might divvy it up and go into something that's a little bit more accumulation based, and you could tie it just directly to the S&P 500. And then you can so you can split the money up into different annuity products. Here's 150,000 in your best strategy that you said was the most aggressive strategy that you had. Or I could just go with a strategy that's specifically designed. So right now there's that, 4.65%. That's on the lower end now. They were a lot higher. And so you can divvy it up in different ways based on what's most suitable for someone. So someone might say to you, hey, yeah, I have $500,000. What I want is I want to have income drawing out of the product. Well, can't really have income drawing out of the product, but also want accumulation at the same time. It's one or the other. You either want to take money out or you want to keep the money in and allow it to go ahead and grow and accumulate. Which is it? What do you want? So if someone says to you that they're 60 years old and they don't need the money until they're 70, oh, okay, you don't need to take money out. Or let me ask you a question. Would you just need to take less than 10% out if you ever needed to take money out? Yes. Okay, fine. I could do a 7-year or 10-year strategy and go with the max accumulation strategy that we possibly have. Okay. And then once it comes time to them saying, hey, I want to take all my money out, I want to start getting a guaranteed check every single year, I want to draw the income, you can then rewrite the annuity. And yes, that means you are now compensated again, right? As an agent, you can then go ahead and rewrite the annuity with a different product that's more suitable for the client's needs at that point in time. What's good for someone at 50 might not be good for someone at 60, and then same thing at 70, right? It might change all the time. So whenever I'm on the phone with clients, and I'll unmute for people to ask questions as well, but whenever I'm on the phone with a client, I mean, that basically is my pitch, right? It's like, hey, right now you have a retirement account that's associated with an index, right? It's associated with the stock market, a mutual fund that's tied to companies, stocks, individual stocks, bonds, whatever they might be. What happens with bonds when a company, let's say General Electric, they have their bond at 7%. Okay, that's what they're paying an interest rate on. But then interest rates went up sky high, and the interest rates are now 9%. So you're getting paid more money than from the federal government, guaranteed, than you would from General Electric. Why would I want to put my money in the General Electric bond? I'm going to sell that bond and go buy something at 9%. But then when those interest rates come down catastrophically, right? They go down catastrophically. The equities, the stocks, okay, they end up going up in more value because it costs them less money to operate on their debt, right? Therefore, you instantly get more money, okay? So I essentially just tell the clients, listen, it's basically right now you have something of a product that has risk inside of it. And you, at your age, let me ask you a question. At your age, do you want to take risk? No. Okay, great. Would you want something that can give you a guarantee that you cannot lose your money? Yes. Okay. And then also that any money that you do earn, your interest, okay, any money that you do earn at the end of that year, that period, that point to point, you can't lose that money either. So let's just say, Miss Mary, you have $10,000, you have $100,000, and you earn 10% on your money in year one. Okay. Year two, you have $110,000. Right? And then the following year, again, you earn 10% again. That's $11,000. Now you have $121,000. And then year three is a major financial recession. The world is ending. Stock market's down 40% like you've experienced in your life, and you don't want to experience again, and you don't want to gamble with your money. Okay. You can't go out. You're not 20, 30 years old where you can just go re-earn it again. Okay, your time horizon of earning money is done. You don't want to go and be a Walmart greeter. No offense to the Walmart greeters, but you get the point. Okay, it's not a bad thing to do. If you need the money, you have to work, right? But you don't want to do that, and you don't want to take the risk. So that's why a product along these lines is suitable for you. Okay, and that's what makes sense. So you can take your retirement account, your 401k, your IRA, and you can put all of it. Those are called qualified funds. Okay, qualified funds. Well, I'm supposed to take out this RMD, this required minimum distribution from it. Yeah. Everything that operates inside of your 401k, your IRA, it's going to operate the same exact way with the annuity. Still get your RMD, you still get the money taken out of it. That's not dictated by me. That's not dictated by the annuity company, by the investment company, the brokerage firm. That's not dictated by them. It's dictated by the federal government. They tell us how much money you're required to take out, okay, for your minimum distribution, because they want to get paid the taxes that you've been deferring for so long. That's what they want. They want their money. You're required to take out a minimum distribution so we can get our money that we let you defer for 40 years, right? We need those tax money now. No more deferring it. We need you to take something out before you pass it to the next generation, okay? So with that said, let's open up for some questions. I'm sure y'all probably have some questions as well. And with annuities, as you can tell, there's a lot to go into. Some stuff might be confusing, but if anyone has questions, go ahead. We'll open it on up. Okay, go ahead. Clay, John, yeah. John, go ahead.
Got a question regarding MYGA. You mentioned there's different rates and they change all the time. Are there any tools or services that we can use for monitoring what the current rates are?
Yeah, so anytime basically that you see the Federal Reserve saying we're changing the interest rates, that's how you know something's going to happen. The rates are generally held for, I would say, quarterly, unless the Federal Reserve is going to change something quickly. They're going to announce it, and then all of a sudden the rates change, and overnight it's going to change. The companies are going to change it. So as far as like tools, the carriers do email that stuff out. So you'll always get an email from Athene, from Royal Neighbors, whatever carriers are contracted with that provide that product. They're always going to tell you, hey, rates are changing, rates are going up, rates are going down. And what I'll do is when I get those emails, I'll keep track of them and I'll send them out to everyone. But yeah, that's a very healthy, easy to sell product. Clay?
I got a couple questions.
Yes, sir.
How does a MYGA differ from a CD?
A MYGA differ from a CD? Well, the MYGA itself is offered by an annuity company, which is a life insurance company, whereas a certificate of deposit, that's going to be offered by a bank. So just two different financial institutions that are offering the product itself. With a CD, you can actually lose the money, right? If the bank was to go under, a bigger bank would come over and take them out, of course. I'm sure you've heard of Lehman Brothers. When Lehman Brothers went under, a lot of people lost a lot of money associated with it. If a insurance company goes under, we have what's called the state assurance fund, which means that that company is going to be picked up by one of the bigger fish, and they're able to buy it, but the policies are guaranteed.
Okay. So basically they act the same.
Yeah.
Okay.
Yeah. So yeah, if you literally have someone that has it, I would say the major difference for a lot of people is the length of an annuity is going to be longer than a CD. But a CD also has surrender charges. If you take the money out early, you're still going to have a penalty, right? So it's in terms of that, the length, but you can have a CD that goes to 36 months. MYGAs are 3-year, 5-year, 7-year. So they're usually 3 5s or 7s. Most people were doing 5 years on. Well, in the high interest rate environment that we were in, prior to the Fed saying that we're going to decrease 3 times in 2024, I'd say that if, for our clients, if we got them a 5.25 or above, and we could lock that in for 5 years, like that's phenomenal. For the people that got 6s, like even better. So yeah, guaranteed, easy product to sell.
Okay. You mentioned bonus credit. That's
Yeah.
credited. That's credit up front.
No, there's a vesting period on the crediting. Every product's going to vary a little bit different.
Not the vesting. For example, let's say you let it just sit there.
Mm-hmm.
You get the bonus right up front, and you're earning interest on the bonus up front. Just you don't get to keep it if you get out too soon. But let's say you don't take anything out. It's from day one.
Exactly. So the interest that's earning on that product is accumulating based on the bonus inside the product itself.
Okay.
Excellent. So that full amount, that 10% bonus, where now you're at $550,000 as your account value. In year one, you get that instantly on your account. Now you don't get to take that money out.
Right.
In the bonus,
right.
But you get that 10% bonus up front. And then there's a vesting period for it for, you to get to keep it and all that stuff. You get, okay, fine. But let's say you earn another 10% on that. It's like, wow, this year I just absolutely crushed it. So now it's $55,000 accumulated and credited to your account.
Okay, you're talking about the Atlantic Coast rates. Those are the
Yeah.
cap. Those are the cap rates you're talking about.
Yeah. So the cap rates with Atlantic Coast, you know, so what's the negative to them? Well, the negative to the company is it's a lower rated company. I think it was like a B+ rated company. Athene's an A+ rated company. I believe they were either A+ or A-. It says it on the top of this form over here somewhere that I was just looking at. But they're, you know, a lower rated company than Athene. So they do have to make the product more appealing with Atlantic Coast Life. You know, maybe they're on the Atlantic Coast by you. I don't know where their headquarters is actually, but who knows? So they could be right, but they do have a more appealing product. And my assumption would be is that's because that they're a lower rated company, whatever that might mean anyways. I mean,
If it's guaranteed, it doesn't mean anything.
It really doesn't. It's like Better Business Bureau. Yeah, I don't think it does. But yeah, I would go with, if you just want to go straight up S&P 500 and they got a product that's 14.5%. On a cap rate, but it's a 1.25% fee. You get 13.25% every year with the S&P. That's a no-brainer. Or you can go with one of their strategies, and you can also reallocate a strategy. You could say, hey, I tried your strategy for 2 years. I don't like it. I want to reallocate, as long as you're not in a 2-year, you know, window of your interest accumulating, a 2-year point to point. Then you can reallocate the strategy as well.
Okay, and last but not least, I had some questions about the participation rate.
Mm-hmm.
So if your cap rate is, I'm just gonna pick numbers here. If the cap rate is 10%, and the S&P goes up 8.5%, and you're at that 200% participation rate, you're just getting the 10%. You're just not going over the cap rate, right?
No. So that's actually a really good question. That's a really good question. So let's actually go into that real quick. Let me just share screen real quick on this so everyone can see it. So when we're talking about participation rates, okay, that's different than a cap rate, right? So on here, you have the S&P 500. This is just a straight up, you invest in the S&P 500 and you're capped at the amount of interest that you can earn on it, okay, of 12.75%. Like that's the cap. That's the most that you can earn on it. This is a little different. Seems a little funky, but they call it a participation rate, meaning that you actually, even though the UBS, IBAL, whatever that UBS is, the bank, the Innovative Balance Index, that even though it went up 10%, they're crediting your account 185% of 10%, right? So it's basically just multiplied by 1.85, right?
So even if that takes you over the cap rate.
Yeah, so there's not going to be a cap rate on these ones. There's only a cap rate on this right here on the S&P 500.
Got it.
Because honestly, I mean, if me and you know, from an investing strategy, it's kind of a no-brainer. I mean, I have my retirement accounts too. I could just take all of my money and I can buy VOO, you know, what I just showed you guys before, the index that is directly correlated. That's from Vanguard, the VOO with the S&P 500. I could just literally just put all of my money inside of it and earn 15-20% every single year. What do I need the annuity for? Well, to make the annuity, you know, they can't let you earn too much inside of the annuity and just take all of your money and put it in there and you get all of the upside potential of the S&P 500 every single year. Like, to them, that doesn't make sense because they're also giving you a floor of guaranteed downside risk. So with the S&P 500 obviously being the most attractive thing that hedge funds can't beat, you know, over extended periods of time, of course, they have to cap you on how much you can earn. Okay. So they're capping that specific strategy, right? If, hey, I want to put all my money in the S&P 500, what can I earn? 12.75%. That's what you're capped out at. Just like a MYGA, the multi-year guaranteed annuity, you're capped at, their product was 4.5% or whatever it was that we just looked at. Okay. But this is different. See how this says no cap on these strategies here? These are no cap strategies. So there's no cap on them. Whatever it earns, if it earns 20%, you get 20% times 2.1, right? You get 210% participation rate as long as you pay that strategy fee of 1.25% every year. That's why when we draw up these illustrations, you look at it and you're like, that just is absolutely, you know, crazy. If we look at the strategy over here, and we just do like a growth strategy. And that's why when we looked at that growth strategy, you know, you look at this number here and you're like, you know, $1.9 million, $2 million in year 7, right? Relative to just taking all the money and dumping in the S&P 500 where you're capped. That's a no cap strategy. Does that make sense?
Yes. And those all still have floors, right?
They all have floors of 0%. Yeah. Zero. That's the least amount that you can earn.
That's all my questions.
Awesome.
Thank you.
Yes, sir. Yes, sir. All right. Anyone else have some questions? I hope that helped. I hope that gave you all some insight. I'll go ahead and I'll chop this video on up and I'll put it online. We will send it on out so that way you have it. All right, everyone, have a wonderful evening. I appreciate your time. If you have any questions directly, just feel free to reach on out to me. You can text me 704-724-3648 or my email, Holden, Holden, @hhhinsurancegroup.com. Have a wonderful evening, everyone.